calendars out. February 17th, February 18th, live trading, San Diego. We got the Lowe's Coronado. I mean, what else would you want? This event is limited to 50 people. Look at your calendar, clear it, make sure you show up. If you want to be a rebel, this is the place to be. You got to sign up for it now. Giddy up, baby.
And good afternoon, market rebels, and to all of our traders out there in YouTube land. This is Trading Tune-Up. We do it every Monday, 4 p.m. right on the closing bell. And speaking of the closing bell, I didn't see it right on the bell, but it looked like we were starting to head into the red on today's candle. We got a nice pop off the opening bell, little gap up, but it looked like it was giving a lot of that back. But still shows that there's still a lot of uncertainty and volatility in the markets. And because of this, we get asked a lot here, whether it's on many of our services or in my Q&A, people all want to know what's the best strategy, or what's the best strategy for volatility, or what's the best strategy for this. And what we really try to show traders is you need to get away from that terminology, because when you start searching for the best strategy, you're going to be led down the wrong path. You have to start with a goal, and you could certainly say, what's the best strategy for me with this goal and with this outlook? But you can't just say, or at least without getting a bad answer, saying what's the best strategy. Now, Stu and I talked about this last Thursday on Coach's Corner, and today I wanted to do a little bit of a follow-on of the details about why you really shouldn't ask what's the best strategy and why it doesn't exist. So that's our topic for today. What is the best strategy? So if you've ever asked yourself this or had other people ask you this, you'll definitely want to pay attention. So here's a couple of profit and loss diagrams. Now the one in black is a long call. It's a $100 call. We can see our bend right there at 100. And we have a short $100 put, which is right there. And as soon as I look at this, I can tell you that it's impossible to say that one is better. And if you can't look at those and figure out why that's true, you will at the end. But for right now, just kind of take a look at those. And does one stick out to you as being better? And if so, why? Now, some people, give you a little clue, some people will look at this black line and say, well, it loses less, it has a fixed downside loss, and it has unlimited upside. Whereas if you sell the put, you've got limited upside and unlimited downside. So they'll say the long call in black is better, and it is simply not true. And again, if you start going into trading with this idea, you're going to be picking the wrong strategies and trades for the wrong reasons. So let's start out and find out what I'm looking at here and why I can tell you that one is not better. Let's start out with a situation where we can definitely say that one is better. Now here we've got the $100 call in red, and we have the 105 in black. They both expire on the same day, so they've got the same amount of time. Let's call it 30 days, whatever. But you might notice something weird here. The $100 call is cheaper. And it should be more expensive because it gives you the right to pay less for the shares. All things being equal, lower strike calls are worth more money. So we know the 100 call must be worth more than the 105, 105 must be worth more than the 110, and so on, again, for any given expiration. But look at this. Now we're seeing that's not true. Now, don't expect to see this happen in the real markets, and I'll show you why in just a moment. But the thing is, for right now, we could definitely say that the red, the $100 call, is better because it wins at every single stock price. No matter whether the stock goes to zero, goes to the moon, anywhere in between, you are always going to perform better on the red line. Now think about it for a moment. If that were true, what do you suppose is going to happen? Which one would you want? Well, everybody else in the market's going to figure that out too. Everybody figures out they want the red curve, the $100 call. And because of this what's called a relative mispricing, it actually sets up what's called an arbitrage. Now, you've heard us talk about this term a lot. A lot of people throw that around, but they don't really understand what it is. But arbitrage is a series of transactions in the financial markets. It comes from the French word for arbiter, which is where arbitration comes from. And arbitrage really takes two conditions. You have to be able to make risk-free money. You're guaranteed to make a profit. But number two, and most overlooked, is that there can be no cash outlay. And the reason that second part is important is if you didn't include it, you could go buy a T-bill. buy a bank CD and say, hey, I had a guaranteed profit, therefore it was an arbitrage. No, it wasn't, because you had to put money up over a period of time. And you needed to put your own money into that investment. Arbitrage is better than that. What you're going to do is you will buy the relatively cheap asset and you will sell the relatively expensive one. And it's going to set up a self-financing strategy. Now, sometimes people think, hey, this sounds unfair, and they call arbitragers. Nowadays, it's not really done from an arb desk, but it will be done from computerized trading, algos and stuff like that. But they'll say, this sounds unfair. These guys are the vultures of the financial markets. And again, that's not true. What they're doing is ensuring that prices are, or assets are priced accordingly, that they are fair for everyone. Because if something does get out of line, this arbitrage process will put everything back in line really within seconds. So with that trade that I just showed you, here's what would happen. So think about it. Even if you knew nothing else, you would want to buy the $100 call. If nothing else, you should say, well, relatively speaking, I should want the $100 call. But we can do better than that. We could buy the 100 and sell the 105. And notice what that's going to do. It's going to create a net credit of 3 in this case. And again, it's self-financing. So it meets that second condition of arbitrage. We didn't need our own money. The market prices just generated this credit for us. Now, normally in the financial markets, if we do a credit spread, we are accepting a liability, which is why we get the credit. But look at this. We are in possession of the lower strike call. We actually own the more valuable strike, and yet we were getting paid to do it. This is another reason why a lot of people lean towards credit spreads, because they don't understand that they're stepping into a liability, not that it makes it bad, but they think that they're getting paid to take an asset spread. But that would be an arbitrage. And in that case, yes, credit spreads would be the best you could hope for, but they're just not. You're taking a liability in exchange for the credit. But this is different. We're buying the relatively cheap one, 1 for 5. We're selling the relatively expensive one. We get a net credit of 3, and what happens? Our risk graph, these two trades, goes to this. Take a look at this. The worst that can happen is we make $3. The best that can happen is we could make the additional difference in strikes, or 5 points, difference between 100 and 105. So we could make 8. But even if the stock goes to 0, we cannot lose. So again, don't expect this to happen in the financial markets. It's just done to say that if it happened, it would quickly get priced in. And that's why, and once that happens, we can no longer say that one is better. So here's what would happen. Again, at a minimum, you should say, if I'm only looking to buy a call, that I should be leaning towards buying that 100 for 5 instead of the 105 for 8. And that by itself is going to put upward pressure on the $100 call. And as traders move out to do it, what happens? The price of that risk graph starts to sink lower because its price is getting higher. But as we start buying the 100 and selling the 105, we put selling pressure on the black curve, and that's going to do what? Shift it higher. So it's kind of a twofold process. It doesn't really matter if people go out and buy the 100, or if they think they just want to sell the 105, or if they want to take the arbitrage and do both. But what do you notice happened? See that point where they crossed over right there? That is called a crossover point. And if they're dealing with any strategy, provided they have the same expiration date, they always have to have at least one. And as soon as you see that, it is a dead giveaway that we can no longer say that one is better, because it's been priced in. Does the $100 call have an advantage over the 105? Sure, of course it does, but you're paying for it. It's been priced in. So look what happens now. If we look to the right of this blue circle, that crossover point, the red line, the $100 call outperforms the black. But if we look to the left, what happens? They flip. The black line sits above the red. It now outperforms the red. So now we can't really say that one is better. All we can do is say that they are different depending on what we expect to happen. So now let's go back to the one that we saw at the beginning, which is the comparison between the $100 call in black and the short 100 put in red. What stands out at you now? Boom, right there. You got two crossover points. And what does that tell you? that one is not better. It's absolutely impossible to say that. Or if you do say it, then you're not looking at these graphs in the right way. Because yes, you could make the argument that the black line does make more if the stock rises, and it also loses less if it falls. No question that the black line outperforms the red out into these wings. But what has to happen there? A fast, aggressive move. We've got positive gamma. But now take a look at the red curve. Where does the red curve outperform the black? Right here in the center. It's got negative gamma. It's got positive theta. See, there's always trade-offs. So the thing that you have to understand when you are setting up trades, don't go looking for the trade that is the best. Don't go look for the one that has the best risk-reward ratio. It is all priced in. You're approaching it all the wrong way. You have to say which one is better for me. And of course, that depends on your risk tolerances and your goals. Now, I did also say earlier that if you have different times to expirations, that you might not get crossover points. So here we've got $200 calls. One is a 30-day in red, it's cheaper, and we've got a 90-day in black. So now you can see it appears that the red is better, but now we see why. It's because it actually has less time. So they are doing exactly the same thing at exactly the same points. The difference between them is the additional amount of time. So just be aware that whenever we're talking about these crossover points, it is, for the most part, when we are talking about the same expiration. So let's try one more here. Which is better? Somebody comes up to you and says the long 100, 105, 110 butterfly or the long 105 straddle. And if you ask most people, they will give you an opinion on which one is better and why. But now when you see the two graphs, what do you see? Crossover points. We know immediately that cannot be true. They're just simply different. And your job as a trader is to say, how are these different? Why are they different? What are the trade-offs? And what am I looking for? So take a look here. If the stock goes out into the wings, sure, the one in black, the straddle, is going to outperform. Get a big move up or a big move down, you're better off with the straddle under those conditions. See, it's a condition. I can't just say overall it's better. Because what happens if the stock stays somewhere close to home? Now the red curve, now the butterfly outperforms. The black curve is hitting maximum losses or pretty close to it. Butterfly is going to have positive theta. It's going to have negative gamma, at least out here into the center. The black curve, the straddle, it's loaded with gamma. We need very fast, aggressive moves for that to become profitable. So the thing that I want you to understand from this is that get out of the habit of saying that this strategy is better and that's why I'm using it. It's not, it's just different. It's all priced in. So to really make the best out of your trading, get out of the mindset of which strategy is better and instead start forming goals, understand what the differences are and the trade-offs are of these strategies, and pick the one that is right for you for those goals. And so for anyone who'd like to learn more, we do have a free 30-minute one-on-one with one of our world-class coaches. You've seen many of them on Trading Tune-Up. We've had Stu, we've had Scotty, we've had Elliot Katz. You can watch them on Thursday at 4 p.m. as well. But a free 30-minute one-on-one consultation. Phone number is 888-809-8058. And one last little announcement for anyone who'd like to come see us live for a RebelCon. We're going to be in San Diego, February 17th and 18th, only 50 people. So this is one of our smaller events. Seats are going quickly. I think we're down to about maybe 8 or 10 seats. So if you want to come join us in beautiful San Diego, definitely give that number a call and they will definitely hook you up. But that's all that I have for today. I hope that helped, and we'll look for you on Thursday for Coach's Corner. We'll see you then.